Hey everyone, this is Kirk here again at OptionAlpha.com, and welcome back to the video trading recap that we do each and every night here at Option Alpha. We go over all the trades that we made today for the membership side of our website, both the opening trades and closing of trades. But remember, this is just for those of you who have signed up to receive our text trading alerts and also this video update. If you're watching this publicly on YouTube or someplace else, you're viewing this video about 5 to 7 days after it's already gone out to our members. So you can't take advantage of any of these trades, especially profitable trades, new opening orders. You're not going to get the same pricing, so you've got to sign up for a membership at optionalpha.com. Tonight we're going to go over the opening trades and closing of trades that we had for Friday. Had a couple little adjustments here on Google, which I want to go over in particular, and I'll go over that at the end of the video because those two trades kind of go together in what we did. But let's start out here with the closing alert that we had on P, which is Pandora. Now, if you watched the video just last night or a couple nights before, we started talking about this iron condor that we had in Pandora. And after earnings the other day, Pandora dropped. And so what we did is we had the call side and the put side, and we took off the call side at a profit. And what we wanted to do was leave this put side on here and see if we couldn't make a little bit of extra money on possibly a bounce in the market. Well, as luck would have it, we actually got that bounce today, and all of stocks were pretty much up. Everything was pretty much up today. And considering that the market was up, we took an opportunity to take this put spread off at a nice profit. Again, 50% of max potential profit, which is what we continuously preach in all of the video tutorials and all of the courses that we do, is that with these credit spreads, got to take them off at 50 to 75% of max profit. So in this case, we had a nice little profit of $15 per spread. We bought back the 30.29 put spread that we had originally sold. And again, we bought back all 4 contracts. So we're totally out of Pandora at this point. Now, moving on to Starbucks. Starbucks is a trade that we have only been in for about 2 days. And the reason that we got into Starbucks was, one, because there was low implied volatility, and we talked about that again in the video alert that we sent out to members, but also because Starbucks had a really tough time recovering. And we thought we needed some extra positive delta towards our portfolio. So we added this call spread, which was very wide. So originally we bought the 65-75 call spread. So that means we bought the 65 strike calls, sold the 75 strike calls. Starbucks was trading right around $70. And today, just 2 days later, we sold the spread for $7 as a credit, took in a nice profit of $160 in 2 days. Now, again, that's not bad at all, and that's what you have to do on these 50-50 bets. Originally, this was a 50-50 bet, low volatility trade. We're just playing the directional side of the market. And when you get a big move like this, you've got to take money off the table. So let's take a look at where Starbucks is and where it was when we actually made the trade, so you guys can get a little bit of an understanding of how quickly the market has turned around. So, all right, so here we are on Starbucks, and we actually made this trade right here near the bottom, and it was just very dumb luck that we actually picked it so close to the bottom to be able to take this trade out in 2 days. But as the market moved up, it's gone up almost 6% in those 2 days. And so with that type of move, you have to be able to take money off the table. A lot of people that I've already talked to said, Kirk, you know what? Why did you take this trade off? You know, we made $160. Why not just let this trade on? It looks like it could continue to go higher. And it very well could continue to go higher all the way through March expiration. But that's not a risk that I'm willing to take. What originally was a 50-50 trade, 50% probability I make money, 50% probability I don't make money, now becomes a 100% probability trade that I actually closed it out, made money on the trade. So I'm going to move on to the next one. And this also helps get rid of some of the positive delta that we have in the portfolio that's been building up. By starting to take some of these trades that are profitable off, we start now to equalize our deltas, which has been a goal of mine for the last week, considering the market's dropped. Starting to equalize our deltas here a little bit. We got a little bit too tilted bullish, which is okay. It's been working out really, really well the last couple days, but we want to start taking off some of those profitable trades. So let's jump around here. We're going to talk about the opening alert that we had on POT, and then we'll get into the Google trade. So we bought a vertical put spread in POT, which is POT, and that was the March contracts, the 35 puts. We bought those and sold the 33 puts against those. Took in a nice debit of 106. What we like to do on debit put spreads and debit call spreads is pay the mid price of the difference in stock strikes. So the strike price difference here is $2. We like to pay about half of that, or the mid price, and that's about $1. So we paid just over the mid price here, making it just over a 50-50 bet. Now, why did we add this in POT? Well, let's go to the chart and you guys can take a look at it here, and then we'll actually go to the actual trade tab and show you where our strikes are. But right now, POT is trading at 33.59. And so you'll notice that along with the general market, POT has continued to move higher and is up 6 out of the last 7 days, I believe is what it is. So it's up 6 out of the last 7 days. So we're just going to play the cyclical side of the market and say, okay, at some point between now and March expiration, so draw a line in the sand exactly where we are, between now and March expiration, which is here, we think that at some point this stock will continue to drop, at least short term, and we'll have an opportunity to take profit. Now, it may not happen right away. It may continue to go higher and then drop, or it may just float here for a little bit and then drop. But what we're saying here is that, all right, at some point, we're going to have an opportunity to take profit as other stock traders start to take profit off of buying the bottom here around 31. So that's our bet here on POT. Where are our strikes on the trade tab? So let's go into the trade tab so you guys can see this. As always, our actual position, live positions right down here on the bottom. So these are always live trades that we're making. And we go to March contracts here. You'll notice that our strikes are straddling where the current price of the stock is. So we have the 35s, and then we skipped all the way down to the 33s. So we're basically straddling the market, which in between that price is 33.5. So that's where we're straddling the market here. You can see we've already made about $26 since the spread opened up today. So not too bad for a little bit of a day profit there, but we're going to continue to hold this position at least for the next couple days and see what we can possibly get. Now, the other reason that we added a put spread is, like I said earlier, we're trying to more neutralize our delta. So we have a lot of positive delta in our portfolio right now, and that's because we started taking off some of those bearish call spreads that we had, and as the market dropped, those became profitable. So we took those positions off, leaving a lot of these bullish put spreads, bullish debit call spreads still on our portfolio. Now, it's been great the last 2 days, but we got to start to neutralize that out. So part of that neutralization is taking off the bullish strategies and starting to add some more bearish strategies, which helps neutralize our portfolio so that we don't get tilted in one direction or another and don't get overweighted. All right, so the last one I want to go over tonight is Google. Now, Google, we've had a lot of adjustments on. So this is one that actually is working out pretty well for us after all these adjustments. And for some of you, it may be hard to kind of follow these adjustments. So please go back to the video tutorial section of optionalpha.com. We have all the members' videos archived right for you. You just got to scroll through them all the way to the bottom. You'll see the most recent one. But in Google, we've been playing Google with earnings here now, getting close to February, and being very strategic about how we're taking in premium. And what we're doing here is taking off trades on each side, rolling the positions, and continuously adding credit. And that's what we have to do. If you're going to hedge and roll contracts, even within the same month, then what you want to do is always take in credit. You always want to take in credit. That way you continue to reduce the cost basis of the trade and continue to bank profits. So in this case today, what we did is as Google continued higher, it went through our strikes on the top side. So we had I believe 1140, 1145, or 1145, 1150 call spread. And we'll go and take a look at that here in a second. But it had gone through that, and Google continues to move higher. And that's okay because we had added a put spread below the market. And today we took that put spread off. So we bought back the 1115, 1110 put spread for a 40-cent debit. So we took in about $111 of profit per spread on that side. So right away, we've already banked a little over $220 in profit. And what we did is, instead of just leaving that there, we actually went in and then rolled that position up. So this is how these two trades are combined. We rolled that position up and added or reopened a new put spread, the same width, the same number of contracts, so 2 versus 2, and a $5 wide spread versus a $5 wide spread, and we took in a credit of 106. So we paid a debit of 40, took in a profit, and then reopened and added some more credit to our overall Google position that we've had and continued to adjust. So what does this position look like now? Because I know a lot of you have questions. Well, here's what we did. I'm actually going to go to the Trade tab first before I go to the Analyze tab. And again, you'll notice down below that we have the positions that we currently have, both the 1140, 1145 call spread. We are now out of the 1115, 1110, so there's no more contracts there. And now we have the 1145, 1140 put spread. And you'll notice that the calls and the puts are almost their exact same strikes. So what we've basically done is minimize the entire trade. Right now we are effectively neutral on the entire trade right now. So Google at expiration can trade anywhere it wants to. It doesn't matter. At this point, we're totally neutral on the trade because we have a slightly inverted iron condor on Google. So if you look at where our trades are, our strike prices are an exact match buy versus sell on each side of the market. So we have calls and puts on both sides, and that means that right now, as it stands, and we plan to make more adjustments on this trade, we are neutral on where Google trades from here through expiration. So if we hold our hands up and say we don't care where Google goes from now to expiration, we're comfortable with the amount of risk that we've reduced in the overall position. We've reduced the potential loss dramatically in this position, and that's what all of trading is about. But we still have 14 days to go left until expiration, so we're going to continue to make adjustments. But what does this trade look like right now on the Analyze tab? And that's what I want to go over with you guys here. So I'm going to go to the Analyze tab. I'm going to type in our Google symbol. All of the trades will come up, and you'll see that we have kind of this funky curved line because as we go through the next couple of days, we have some changes in implied volatility and changes in prices. So this is what our profit loss diagram looks like currently with all these kind of volatility factors and time decay factors left for expiration. But if you look at this red line right in the middle, you see that it's totally and completely flat. And that means we've basically neutralized this position for now. And it's a strategy that I use when the stock continues to move so rapidly that I want to neutralize this position so that I have an opportunity to adjust either the call side or put side depending on where Google goes next week. So neutralize the strategy before the weekend. If Google continues to go higher, then what we'll do is just close out the put spread we just entered, close it out for a profit, and roll that contract up to the next set of strike prices. Now, if Google drops dramatically, and today it closed at 1177, so obviously we have a lot of room between where our strikes are and 1177. But if Google drops next week as we head towards kind of the last 2 weeks of expiration here, then we do have an opportunity to then either roll down the put side and add to the position or roll down the call side possibly and take some profits off that way. So there's a lot of options here, but this is a quick way that we've neutralized the position heading into the weekend and planning to make some more adjustments next week. And a really good strategy. Not a lot of people do this. They kind of shy away from doing this because it just kind of locks in this flat line profit loss diagram. But at least at this stage, we've made a lot of adjustments. We've also taken in a lot of credit and banked a lot of profits on both sides for Google. So this is turning out to be a really, really good trade, even though it went against us early in the expiration cycle. So again, hopefully you guys enjoy these videos. These are always here to help. So I'm trying to get deeper and deeper into the analysis of why we're doing what we're doing. And it only helps to understand all this if you've signed up for a trial here at optionalpha.com. You get the text trading alerts, you get the video tutorials at night. It just makes it really, really helpful to follow along. So hopefully you guys have a good weekend. And please, as always, add your comments or question right below this video to the comments section. I'll get to everyone in this video. Happy trading.